China's plan to destroy the dollar, and it's kind of working.
The nuclear option, that is, selling U.S. treasuries, U.S. bonds.
Beijing striking back today with a 125% tariff on all U.S. goods sold in China. This comes after President Trump placed a 145% tariff on Chinese imports.
And what I learned this week is that the most important thing to look at right now is not the stock market, it's the bond market and their interest rates. Now, right now,
Is it though? Isn't it funny how everybody's like a foreign policy expert, a stock market expert, the bond market expert, etc., right? In my opinion, stay in your lane. Stay in your lane. Learn as much as you possibly can about your lane and let other experts tell you how expert they are. I have a feeling that he's not an expert based on what he just said. And I'm a little bit disappointed because I really thought we were going to learn something, and hopefully we do learn something, but he's a bond market expert now. Good to know.
yields on what's called the 10-year treasury are going up. And that's because when countries like China start to sell off US debt, which are their treasury bonds, it creates a ripple effect that hits everyone, which means to get new investors to buy US debt, interest rates have to go up, not down. So I want to help explain exactly what's going on, because this might actually be part of a strategy not to crash the markets, but to corner China, the same way we cornered the British pound in the 1990s. And once you see it, it's going to explain everything that's happening today and how it's going to affect your 401ks, rising mortgage rates, all the way to the emergency Federal Reserve rate cut. So let me break this all down and explain exactly what's going on, and I'm going to show you what I'm personally doing with my money, so let's get into it. Hi, my name is Andre Jick. Hope you're doing well. Come for the finance and stay for the 401k Hunger Games. I used to have a 401k, now it's a 0k. So this video is about to get insanely complicated really fast, but if you stick with me, I promise it'll make sense. And if you get through it all the way and you understand it, you're a nerd and I appreciate you. So here's what just happened. In early April 2025, something happened to the bond market that usually never happens, which was the sell-off of US treasuries. By the way, whenever you hear me say treasuries or bonds, they're the same thing. I'm using them interchangeably. Now, the most important...
Okay, so let's do something real quick. So if you look up the TLT, okay, so as far as I understand, the TLT tracks a 20-year, 20-year treasury bond ETF. Now, if we're not talking about the 20-year bond ETF, please enlighten me. Maybe we're talking about the 10-year, which is TNX. We'll look at that in just a moment. But let's do some real good context. Let's set the stage real quick, right quick. This price, April 15th, 2015, is the same price as it was December 20th, 2024. Were we freaking out about bonds at that point? I don't think we were. And in fact, it's the same price as it was April 24th, 2024, literally a year ago. Were we freaking out about bonds right then? I don't think we were. So if price is what matters, because at the end of the day, that's all that matters, and it's the same price as it was a few months ago, and it's the same price as it was a year ago, why are we freaking out? Maybe I'm wrong. Let's go to TNX. Right? TNX. Oh, no, damn it. Hang on. I thought that was the right one. 10-year treasury stock ticker. That was TNX. Yeah, TNX. I ain't crazy. I know you think I'm crazy, but I ain't crazy. Is it? I have to do the caret TNX? There. Oh, hang on. Hang on just a moment here. Procedure, exchange agreements. I confirm my legal name. Just a second here. All right. Oh, congratulations, you're done. Okay. That was weird. Okay, TNX. All right, this one definitely looks different than TLT. Let's look at both of them side by side. So on the left-hand side is TLT. This is the 20-year bond ETF, TNX, which I swear there is a ticker for, what is it? TNX, yeah, I know it is. I think it is. Okay, anyway, let's do that again over here. So TNX. Okay. So let's zoom out just a smidge. All right, so on the right-hand side is your 10-year. On the left-hand side is your 20-year. I mean, They seem to be very range bound to me. There are there some movements, yeah, but like again, this price right here, April 7th, is the same price as it was in October. This price right here is the same price as it was in December. What crashing bond market are we talking about? I could be 1,000. Listen, this is not my lane, but what is my lane is only price pays, and I don't see what the people are freaking out about. Randy's saying ZN. Let's look at ZN. ZN. Oh, hang on. Is it ZN like this? Forget how to do futures. You gotta do futures a weird way. Hang on. Futures. Oh, it's with the exclamation point. Okay. ZN exclamation point. Exclamation point ZN. I don't know. Either way. I don't know why I can't look that up. / ES. Yes. Exclamation point. Stock ETF. Yeah, I mean that's ES1. Is that ES1? There. Okay. So like Z and 1. Boom. There it is. All right. Still, that's almost the same as it was for T and X. Okay. So we'll just use T and X. Isn't this fun as I'm trying to do this live? Okay. Point is, I don't see what the whole hubbub is all about. I don't see why everybody's become a bond expert. I don't see why people are freaking out about bond prices. Do you? I don't know. Maybe he'll teach me something.
Important one of these treasuries is the 10-year treasury bond and its interest rate. And the 10.
Okay. And to his exact point, the chart that he's brought up, well, nothing's happened. Nothing has happened in months, in years, in fact. Why is everyone freaking out about bonds?
10-year interest rate or yield went way up recently, which is completely the opposite of what we want to happen. And all signs point to China and Japan. Investors believe that right now, foreign countries, especially Japan and China, which are the two biggest holders of US debt, are dumping US Treasury holdings as a way to fight back against President Trump's tariffs. And this isn't just coming out of nowhere. China's been slowly pulling out for years. In fact, by the end of 2024, they were already down to about $760 billion in US debt, which is the lowest level since 2009. And all of this was started by just one move: tariffs. On April 9th, 2025, President Donald Trump hit China with 104% tariffs on all Chinese imports. China then responded immediately with a 50% retaliatory tariff on all US goods. That raised China's total tariff on American imports to 84%. And if you think that's crazy, President Trump came back again and raised the US tariff to 145%. And then China responded with their own 125%. All of this, by the way, happened in just 1 week. So it's no wonder the stock market just can't decide whether it wants to go up or down right now. But here's where it gets interesting. While President Trump raised the tariffs on China, he actually paused or lowered on a bunch of other countries. So now the pressure is on China. And what did China do? They didn't just raise the tariffs. They filed complaints with the WTO. They put restrictions on 18 American companies. They restricted exports of rare earth materials. And the biggest move, they started selling US treasuries. That last one is the one that makes investors really scared. And that's because when China sells their treasuries, the bond prices fall, and that means our interest rates go up. But first, let me just explain why everyone is freaking out over the bond market and why it's so important. Now, the bond market is so important that it can control interest rates, it can control the central bank, the stock market, and even the president's actions. So let me just first explain how bonds control interest rates and the cost for us to borrow money. See, most people think that it's the central bank, the Federal Reserve, that sets our interest rates. But that's not completely true. The Fed controls short-term rates, like what's called the overnight lending rate between banks and the federal fund interest rate. But long-term rates, like the 10-year treasury, are controlled by the market, by buyers and sellers. Now, if countries like China are selling bonds, the Fed can't stop that overnight. So what happens then to interest rates when bonds get sold off? Their rates adjust upward. And that's because bond prices and their interest rates move in opposite directions. If the price of a bond drops, the yield goes up. So here's an example. Let's say a bond pays you $50 a year. If that bond was worth $1,000, that's a 5% yield. But if it drops to $900 and you still get $50 a year, you're now earning 5.5%. And that's what we mean when we say yields are going up. That means bond prices are dropping. and they're dropping because someone is selling. But now, imagine hundreds of billions of dollars of bonds being sold at the same time by China and by other foreign governments.
Okay, so this is a hypothetical. So people are freaking out because China does own a lot of US debt. Don't ask me how much because I don't know. And the idea that, hey, they could sell these things in the trade war is freaking people out. Okay, I can get that. I can get behind that, Nico. I can get that.
Governments that are watching this play out.
But if we're to look at what's actually going on here, I would say a whole lot of nothing burger. I would say a whole lot of nothing burger. Nothing has really happened to the bond market yet. So is this just like a what if scenario? Is this just talking points where people are trying to get clicks? Because like as a trader looking at these charts, I'd be like, meh, it's sideways. I mean, if you want to see what you want to see, we covered this one this morning. You want to see what real panic looks like? Like a TTD. Yeah. You see the difference in one of these things does not look like the other, right? The one on the left is very much people freaking out and getting out of this as fast as possible. The one on the right, meh. So I guess it's really hypothetical. Like China could do this. China could do this. It would be tremendous if they did not do this, but they might do this. I don't know.
That forces US yields even higher. So interest rates go up, and that's exactly what we're seeing right now. And this is a big deal because higher yields make it more expensive for the US to borrow money. And with over $30 trillion in national debt, that's not good. And if interest rates get too high too fast, it can break parts of the US economy and force it to deleverage. And bond markets can also force the president to do exactly what he just did, to back off the tariffs for 90 days so we don't break even more parts of the US economy. That's how China is fighting back.
What? You really think that these itty bitty moves right here? No way. I disagree with that wholeheartedly. There's clearly more to the story. But if you're telling me that this move, prices crashing back to the level they haven't been seen since February, prices screaming, crisis in the bond market when prices are the same as they were on February 19th. Really? I can't believe that.
It's dumping US treasuries, which forces interest rates upward and breaks part of the US economy. That's why the Fed might have no choice but to drop rates. And this is where I want to share with you a new theory about what's really happening. It involves this guy, Scott Bessent. He's President Trump's Secretary of the Treasury. Now, in the early 1990s, Scott Bessent, along with George Soros, broke the Bank of England. And here's how they did it. Back then,
which this is really cool, by the way. This is in the original Market Wizards book. By the way, if you have not picked up the original Market Wizards book, tremendous book. It's absolutely tremendous. But because I know several of the Market Wizards, this is one of the greatest trading stories ever. It's actually really cool. Now, political opinions aside, George Soros like spanked England. Like he literally nearly crashed the entire currency of the British pound. So hopefully he does a good job explaining this.
The UK was part of what's called the ERM, the exchange rate mechanism, which was a European agreement to keep currency values relatively stable against the Deutsche Mark.
There are going to be no devaluations, no leaving the ERM. We are absolutely committed to the ERM. That is our policy. It is at the center of our policy. We are going to maintain sterling's parity, and we will do whatever is necessary. And I hope there is no room for any doubt about that at all, that the government is determined to maintain our position.
The UK wanted to keep the pound within a specific price range. And to do that, they had to defend it by raising interest rates or using foreign reserves if needed. But there was a problem. The UK economy was weak. Inflation was high, unemployment was going up, and most importantly, interest rates were already way too high for their economy to handle. So Scott Bessent and George Soros realized the UK couldn't keep it up. They believed the pound was overvalued, the UK couldn't defend itself forever, and eventually they'd be forced to make a choice. Either devalue the pound or leave the ERM. So here's what they did. They shorted the British pound. That means they borrowed pounds and sold them, betting that they could buy them back later for a lot cheaper. Some reports say they bought over $10 billion worth of shorts, but they coordinated this with other big institutions who saw the same opportunity. And when Bank of England tried to defend the pound by raising interest rates and buying pounds with their reserves, George Soros and Scott Bessent just kept selling into it. Eventually, the pressure was too much, and on September 16th, 1992, the UK withdrew from the ERM.
A unique day in London's financial markets ended with the Chancellor announcing that the pound was being suspended from the ERM and that the second of two dramatic interest rate rises during the day was after all cancelled.
Today has been an extremely difficult and turbulent day.
The pound crashed, and that day became known as Black Wednesday. And George Soros made over $1 billion on this trade. And Scott Bessent was the key architect behind how it happened. So the question is, how does all of this relate to China and what's happening right now? And why this all relates is because Scott Bessent is recreating a situation where a country is forced to make one of two very hard decisions. China is forced to choose between weakening their currency or defending the yuan. Now, if China weakens the yuan, that would be good because it would make exports cheaper and help offset the impact of President Trump's tariffs. But it could also trigger a panic inside of China because that would create inflation and investors might rush to move their money out of the country. It could make borrowing a lot more expensive and it could even destabilize China's entire financial system. It's called a flight of capital, which is money leaving that country and being invested into other foreign assets like gold, Bitcoin, and things like that. That's a very hard decision to make. Or there's option number two, which is what China's choosing to do instead right now. And that is to keep the yuan strong and to defend the value of their currency by selling their US dollar reserves to buy up the yuan. But to get to those dollars, they have to sell US Treasury bonds. And that's exactly what we're seeing right now. So from the outside, it looks like China is retaliating against the US, but they're also doing it to keep their own system from falling apart because they have to. The real question is, how long can China sustain defending its currency before they run out of dollars to support themselves? And China's looking at the US and thinking the exact same thing. How long can the US allow their bond market to be so high and to have this high interest rate before their own economy unwinds, goes into a recession, and they have to refinance $9 trillion worth of debt in 2025 at this super high interest rate? That's why there's a capital flight in the US as well. Money leaving the US stock market because investors are saying, we're just going to wait and see how this all plays out. Which means we're full circle. We're right back to the bond market. That's why yields are spiking, mortgage rates are going up, and why everyone is panicking about the debt again. It's a race against time for both countries. And in that sense, it's not helping anyone. So if this is really Scott Bessent's strategy, he's trying to engineer a situation where China's under so much pressure, every move they make just creates more problems with the goal that both countries come together to negotiate something more favorable for both of them. So the next big question is, what happens if China keeps selling US Treasuries? And a few things could happen, and none of them are really good. First, US interest rates could go up, making mortgages, credit cards, and of course car loans a lot more expensive. So the Federal Reserve might have to step in and start buying US Treasuries to stabilize the bond market. It's basically quantitative easing all over again, QE 2.0. And we've seen what happens when the Fed prints money. Any day now, we could see the Fed step in to do this. But the worst case scenario is a full-blown financial decoupling, where the US and China stop trusting each other's money completely. And that's how you get two separate economic systems or two world reserve currencies. Now, we're not there yet, but every move we make from here on out matters a lot. And the good news is that no one knows exactly how this ends, not even the people that are in charge. We are just making it up at this point. But here's what I do know, and here's what I'm doing with my money and how I'm investing. Right now, I'm staying invested. And as crazy as this gets, I'll keep doing.
Yeah, I'm not. I'm in cash. I'm on cash for purpose. Okay. So I appreciate him having taken the time to research a lot of this, right? I think this is more of a news created panic than anything else. You know, we've got this guy who architected the takedown of the British pound, who's leading, you know, whatever department he's leading. And so I think people are trying to put that connection 2 and 2 together with the fact that we are levying these tariffs against China and how China could retaliate. So interesting. I don't have much to say about it, which is why a lot of it I was just listening. But you tell me, what did we learn from this video? I would really like to know what you learned from this video. Just so you know, this guy was once a magician. That is his background. I've worked in finance since 2009, and he's a magician. But whatever. I didn't do any research on this. I just wanted to hear. Brian says, playing chicken with the American economy, it's not a great idea. Not a great idea. I kind of agree. By the way, there's our thumbnail today. Let me introduce myself. I am a random guy on the internet, but my random name is Christopher Ewell. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards since the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe if you haven't already. And do me a favor in the chat, tell me, what did you learn from today's video? That's what I'd like to know. What did you learn from today's video? We learned that nobody has any idea what's going on. That is the truth. That is the truth. And Dormith, here's the cool thing about it, right? You don't have to know what's going to happen in the markets. That's a core principle from trading in the zone to make money. You don't have to know what's happening in the markets to make money. What you do have to know is how much risk you're willing to take to find out. So great point there. No, Anthony, no, you're going to make me blush. You're going to make me blush. All right. Since we didn't learn anything, let's talk about outlierdeal.com. So let me go over that real quick. OBTOYRdeal.com. So I need you to go to outlierdeal.com right now because we are giving away a free year of Outlier and $1,000. And all we ask is that you share a couple things for us, and then you'll be entered to win. Some of the things is like watch a couple videos, enter a couple secret codes, visit our page, do a couple retweets, things like that. And of course, leave us a review. Top prize is Outlier 3.0 for a year, plus $1,000. First runner-up gets $200 worth of Outlier merch, plus my 5 favorite trading book bundle. And second runner-up gets $150 worth of merch and my 5 favorite trading book bundle. So we're going to shift gears because I want to get right over to today's member highlight in our Discord. So there was a question from Earth Native, and I hope Earth Native is watching, but I want to answer this question fully and completely. So Earth Native says, I watched your excellent video, Ask Me Anything, which we're going to do every Friday from now on, except for this Friday. This Friday, the market is closed. I actually am going to, as of this afternoon, I'm planning to go to our lake house. I hadn't planned on doing that, but I was talking to my dad earlier, and I'm like, why don't we go to lake house for the weekend? He's like, let's go. Let's do this. So I will be out of town on Friday. But he says, I watch your excellent videos, Ask Me Anything, and also how I lost 128,000 one options trade. Very grateful for the explanations you provided. And these are fantastic opportunities for me to educate you because this is my jam. Oh my gosh, I love to do this. I don't have to do this. I have the privilege that I get to do this with you. Q&A on Fridays, this is an excellent idea. So my question is to you about trading the 80 delta long calls or puts. Now, what about IV? So IV is implied volatility. Falling IV goes against you. So naturally, you need to buy in a low IV environment. What about optimal expiration time? Is it 21 days? There's still a decay on such trades like Meta. And after 5 days, there's a decay of about 4%, not counting the volatility drop. So what's your premise on volatility and decay exits? Second question, if there's a downtrend, why don't you short by selling the shares instead of long put options? So we'll address the second question first. Why not do short shares versus puts? Well, of course, because it's the leverage, right? It's the leverage. I can put up 10% of what I'd have to put up if I were in short shares and get nearly equivalent results. So because of that, I can now do more in my portfolio because these are leveraged investments. These are not YOLO calls. And we're gonna talk a lot about that. Now, to a couple things here. What about IV? Falling IV goes against you, so naturally you need to buy in a low implied volatility environment. So there was or is a channel called Tasty Trade, and I'll call them out by name, but I've had the opportunity. You can go look on my YouTube channel. I've worked with Pete, Dr. Jim, Tom Sosnoff, Tony Batista, and many others. And I had somebody say one time, Tom Sosnoff doesn't know you, bro. Give me a break. I've been around this industry for a while. Most people know me at this point. Point is, they really, really push the idea of selling options. And I drank the Kool-Aid as much as you could possibly drink it. And in the process, I was selling all the options I possibly could because the theory is, and this is the difference between theory and practice. The theory is just sell options anytime, collect the premium, and then you just do it day after day. And it's just like rental income. You're going to get paid no matter what. And then if for some reason the stock doesn't work for you, just continue to roll it out in the future. It'll eventually come back. Don't worry about that. They always come back, right? Kind of paraphrasing, but kind of not. So to that point, their whole thing is you want to sell when option prices are juicy, when they're expensive, and you want to buy when option prices are low. I'm of the opinion of, I don't care. I do not care if option prices are expensive or if they're low priced, because that is not how I trade. I do not care how expensive these options are. And we're going to talk about how we figure that out in just a minute. But specifically, I had this conversation with Steve Burns. And as you guys know, Steve's a friend of mine, one of my key mentors that I learned from. And I had this conversation with him, and I was talking about selling iron condors, selling these calls, selling puts, selling spreads, etc. And Steve said to me, you know what, Chris? I used to trade that way too. But then I realized I wanted to make money. And that was such a slap in the face to everything that I had learned for years. But I had sought out Steve because I could not make money in the markets. I kept losing. I had an 84% win rate, and I was losing money hand over fist. Now, I'll tell you why and how. That's because one trade going wrong, which we discussed in the video with Invest with Henry. One trade, in his example, would take him 10 trades. No, it was 12. One losing trade would take him 12 trades perfectly executed to make back. So the math behind that, it was an 84% win rate, but it takes me 12 trades to get back to break even. This math is never going to work. This is never going to work. And that is what I was going through. That is why I could not make money in the markets. But to the question of implied volatility, how much does it matter? I say it doesn't matter at all. So let's talk about what implied volatility is. There's this video here, Options Trading 101. What is IV Crush? We're going to watch this for just a moment. We're not going to watch the whole thing. We're just going to have them explain a couple of key concepts here so we're all on the same term.
What is implied volatility, or IV? Implied volatility is a metric used to forecast the likelihood of movement in a security's price. IV is quite useful in projecting a few things such as future price moves, supply and demand, and pricing options contracts. Also, we have several factors that come into play when calculating implied volatility. But two of the major determining factors are supply and demand, along with time value. Implied volatility and options trading. Implied volatility is often used to price options contracts. High implied volatility results in options with higher premiums and vice versa. As you probably already know, we use two components to value an option contract: intrinsic value and extrinsic value. If you're new to options and this sounds Greek to you, the extrinsic value represents the risk premium in an option. Furthermore, when the perceived uncertainty of a stock's price is increasing, we see a rise in demand for options contracts in that security. When this scenario happens, the extrinsic value of the options increases in value, and this translates to a rise in implied volatility. Typically, this scenario plays out as a company's earnings date gets closer.
Okay, we're going to stop for just a moment. Remember, the extrinsic value of the option is what increases when there is more implied volatility. Your intrinsic value cannot change. Your intrinsic value is math. Your extrinsic value is determined by the market makers, by how many people are interested in getting it, right? If there's more uncertainty in the market, extrinsic value grows. Intrinsic value cannot change like that.
What is implied volatility crush? The IV crush is...
Okay, we don't have to worry about that so much. So let's jump into this, right? Let's jump into the question here. Falling implied volatility goes against you, so naturally you need to buy in a low implied volatility environment. So I did add intrinsic and extrinsic on here, so this should be easier to show you and calculate. So every stock that has options is going to have options that are in the money and options that are out of the money. And in the money option is the difference between the strike price and, the strike price up here and the current price. Current price at 520. So anything below 520 is in the money if you're talking about calls. And just for simplicity's sake, we're only going to talk about calls. So for example, the 450 calls are $70 in the money right now because the price is 520 on Meta, in the money by $70. Okay. Now that is reflective here in the intrinsic value. Intrinsic value is how much moneyness, how much your investment is worth. Okay. Keep this in mind. Your intrinsic value is how much your investment is worth. And that's calculated from the current price minus your stock price. So that's intrinsic value. Next is extrinsic value. Extrinsic value is what we just talked about a minute ago. This changes. This is how much volatility there is with the stock. So for me, my go-to and I'll show you what I mean. Whenever I'm looking to pick a stock, is I'm starting at 21 days to expiration. Why 21 days? Well, generally the outlier signals are roughly 21 days or so. We're going to look at BXSL, just the first one that pops up right here. I'm going to go to the performance summary. And you can see outlier had 11% returns versus buy and hold at negative 3.85. But beyond that, the average holding period, only 6 days in this one. If we go to another one, we can go to Dole. I guess that's the banana company. This one has average holding period of 17 days. Let's go to another one. MLTX. Moon Lake Immunotherapeutics. That's a big word. Average holding period, 13 days. So for me, I start at 21 days. 21 days gives me enough time to hold for the entire signal if I need to. But you can always go more, and you can always go less. That's just my starting point. I look for 250 on my open interest. Now, why 250 in open interest? I had a mentor tell me one time, you want to go for a stock that has at least 4 to 6 times as much in open interest as you need to buy. So for example, if I'm buying 40 contracts and I need 6 times as much, that would get me 240, rounded up 250, right? If I'm buying 60 contracts, I need to get 4 times as much, that would be roughly 250, right? So at that point, I know that there's plenty of liquidity if there's more than 250. Next, I look for less than 50 cents on the bid-ask spread. The bid-ask spread is the difference in what you're going to buy it for versus what you're going to sell it back for. Now, let's use this example right here, the 430 calls. If I were to buy this right now, it would cost me $100.30 per contract, which is expensive, really expensive. But to sell it back, I would only get $98 right there. So I would lose $2 just from the buying and the selling. I don't want to do that. I don't want to do that. For sure not. So I would be more down here where it's only 30 cents between the buying and the selling versus $2 for the buying and selling, right? And let's go back to here. But one key thing here, and it always puts me around the 80 delta, is I want 20% or less extrinsic value. And it always puts me around the 80 delta. It might be as low as 71. It might be as high as 91, right? But it always puts me around the 80 delta. And that is just the math behind it. So let's see, where's the 80 delta? 80 delta right here. So if I did extrinsic divided by the ask price, so how much extrinsic is it if I'm going to buy it right now? So we'll put this over here like this so it's easy to see. So 1224 divided by 78. We'll do 78. 15%. 15%. Now, does this have liquidity I want? No, but I'm not worried about that. I'm just trying to show you the extrinsic value versus the ask price. Now, this is why I don't care about if implied volatility is high or if implied volatility is low. Because if implied volatility is high, you know what I'd have to do? I would have to just go up a couple strikes. That's all I'd have to do. And now I'd be looking at $9 over 90, right? Or if implied volatility is low, I would just have to go down a couple strikes. And then it'd be still, somewhere in the ballpark of 20%. Because that's my wheelhouse. That's my wheelhouse. So when it comes to implied volatility, I don't care. I really do not care how much extrinsic value there is. It doesn't matter to me in the least. Because all it's going to do is change if I buy the 50 strike or the 52 strike or the 48 strike. Doesn't matter. And will implied falling volatility go against you? Possibly. So let's talk about what that means. Let's talk about what falling implied volatility goes against you. So I created this slide. So I always look at this image, and so I just decided to grab the slide and make one. So in the money options versus at the money / out of the money, I wrote this over here because they behave similarly. And in the money option, like what we're talking about, the 80 delta, this would be considered a leveraged investment. A leveraged investment because I'm only going to pay as little as I can for this extrinsic value, as little as I possibly can, but generally 20% or so. versus the out of the money options, the at the money options. These are lotto tickets. These are your hoping and praying that something works for you. Now, what you'll notice here is the height of these and the slope of these. In my in the money options, these are going to decay no matter what. All extrinsic value on every stock, on every time frame, on every expiration, on everything forever and ever will decay to zero. Extrinsic value always decays to zero. Intrinsic value is calculated from, as we talked about earlier, the price of the stock minus your strike price. So when I'm buying an 80 delta option and 80% of it is in the money, and I'm only having 20% of it as extrinsic, only 20% of my investment can decay. Now, granted, that's more than zero for sure, but it's a hell of a lot less than 100% of my option can decay. So if we look over here, we can see that if we were to buy the 525s, it has $30 of extrinsic value and absolute zero intrinsic value. Absolute zero intrinsic value. And because of this, 100% of this will decay versus only 20% of this will decay. Do you see how the height difference is here? In fact, I could probably add this over here. 100% and then 20%. Cool. Now, as time goes on, the slope of this curve gets a lot steeper, right? So for those of you who are buying 0 DTE options, you have no time to be right. You're either right or you're wrong. It's either Lambos or food stamps. But if you're buying something 21 days out, right, it's going to decay. That 20% might decay over 21 days. So therefore, my decay per day, so if it's 20% divided by 21 days, my decay per day is less than 1%. Less than 1%. However, if you're buying the out of the money options and 100% of it needs to decay in 21 days, that means 4.76% will decay per day versus less than 1% to decay per day. Does that make sense? Jenny, I know I got real deep in options. You don't have to you don't have to understand, but of course, please rewatch this video. Maybe that'll help you. But we had a question in the Discord about how important it is for implied volatility. And so I wanted to really take a little bit of time to real nerd out. This is what I do. This is what I do. So don't stress if you don't understand. That's okay. Now, the out of the money options, like I say, they're lotto tickets. You're hoping for the best, but you have this big monkey on your back, right? You've got the big monkey with the big hammer coming down on your back the whole time, right? And that monkey is hammering you every single day by 4%. And in fact, it's going to grow every single day. And it might be 4% at the start, but it's going to be even more at the very end. And it could be less, but it could be even more at the very end. Now, both of these extrinsic values will go to zero at the same time, but one of them is about 20% of the price, whereas the other one is 100% of the price. So if you are looking for implied volatility to buy, you want to be buying as little as you can. But if you want to sell it, you want to sell as much as you can. But here's the deal. Do not sell options. Do not sell options. Do not sell options on Thursday. Do not sell options on Tuesday. Do not ever sell options ever, because the risk to reward is skewed so far against you that you're never going to make it up. You're never going to make it up. Is that because we may sell the option? Right. If somebody is selling the option, they're trying to get the extrinsic value. They're trying to milk this value, right? But here's the insidious nature of selling options. To get this value, you have to wait. You have to wait until it comes down in price. And that could take a couple days. It could take a couple weeks, and it will come down. We know for a fact all extrinsic value will go down. But you have to wait. And if you are in a trend that's going down, like investment with Henry was describing, he sold options on, was it Microsoft or was it Meta? Maybe it was Meta. I don't have Meta saved. Hang on. Oh, yeah, it's right there. Yeah, it was a Meta. He sold options on Meta as it was going down. He sold puts on Meta as it was going down. So he needed time to work in his favor, and time was not. It was in a downtrend and continued in that downtrend. And so while he's hoping and praying and waiting for the decay to come down, because the decay is coming down no matter what, he's being overridden. He's being overwritten by the Delta move. Now we're going to get real nerdy real quick. Now we're going to get real nerdy, because when I trade options, I'm trying to maximize my Delta move. I don't care about the extrinsic value. I don't care about the Vega. I don't care about the Theta. I don't care about anything else. If I can maximize my Delta move, that's where I'm going to get paid. Now, what is Delta? Delta is the change in value for every $1 change in the underlying stock. So we talked about earlier, I go for the 80 Delta. That means for every $1 that the stock goes up, my option will go up by 80 cents, which you're probably thinking, Chris, this sucks. Why would you want that? Because it's practically impossible to get a 1-for-1. But this is the best leverage that I have found. And this was taught to me by Larry Hite, the very first billion-dollar hedge fund manager. This was not my idea. This was his idea, and it totally made sense to me. Whereas if you're buying out of the money options, let's say you bought 4 times the 20 Delta, okay? So that would cost you, let's say, 770 times 4. 770 times 4. So it costs you $30.80. Whereas if I go up to the 80 Delta, it's going to cost me about $80. That's significantly more. I will tell you that, significantly more. But keep in mind, 80% of my option is already valuable. Only 20% of my option can decay. Whereas 100% of your 20 Delta option can decay. So who has more risk here? I would venture to say you, with your out of the money YOLO calls, because you have no moneyness. You have nothing in the money. Whereas I have 80% of my investment in the money. Blue Hoodie says, I love selling options just to watch Theta make me bank. Unfortunately, dude, it will work up to a point where it doesn't, and then it will hurt. So the old adage is selling options is equivalent to picking up nickels in front of a steamroller. It's going to make you bank at some point, and then it's going to take it from you and more and more. Yeah, it's literally Greek. It's alpha, delta, beta, gamma, theta, rho, all those others, right? Brian says, it won't come down before you have to exit. Yeah, that's the thing. Is you're trying to get the extrinsic value to come down if you're selling the options. You're trying to get this curve to come down if you're selling the options. But how long do you have to wait for it to come down? How long do you have to wait? That's the hard part, right? Shane says, I can confirm, do not sell options. Yeah, Senior Wahoo, for sure. Andy says, I will not sell them near or far. I will not sell them in a car. I will not sell them at all. Sam, I am, for sure. Francis says, I was introduced to selling options as rental income for stocks. The idea makes total sense. And that's actually, I think I mentioned that earlier as an example. The idea makes sense. The problem is if your stock turns against you, that would be equivalent to the tenant taking your house and setting it on fire. Actually, that's a really decent example, right? You're collecting rent month after month after month. And then your tenant's like, meh, I don't want to live here anymore, right? Get the matches. Just set the house on fire. And then you're losing so much more than you ever made in rental income, right? Somebody in the chat not that long ago, and maybe if you're here watching live, tell us. But somebody was on Tasty Trade specifically talking about how they had one losing trade, and it took out 10 months. 10 months of selling lost in one trade. 10 months of selling options evaporated in one losing trade. I'm here to tell you, do not do that. Do not do that. But if you are going to buy options, buy for as little as you can in the extrinsic value. Maximize your intrinsic value, because that is the leverage investment that you're talking about. Luca Tubo, thank you. And thank you for sharing that story. That really stuck with me. Brandon says, I sold options one time listening to Uncle Tim. I think that's his name. He was from Nova Scotia. Okay. Either way. So let's do this. Let me scroll up just a smidge. let's go see what the market's telling us. Let's go see what the market's telling us today, right? Is there any opportunity to get into the market yet? What is the market telling us today? Let's go to the SPY. And I still hold true to my theory. And listen, as a trader, I am comfortable with being wrong. If I'm wrong, I'm wrong. Big deal. I move on. But I think we have already printed the lows. I think we are going to see some constructive work put in on the markets. And we do have the price over the 10 right now, which is the indicator of the short-term trend. If it can continue over the 10 EMA, then I think it's got some legs. But we don't know how long it's going to stay. And we don't know if Trump's going to do anything weird, because he's been known to do that lately, right? If Trump does something weird, all bets are off. But we don't have the 10 over 20 price over 50 just yet. So this is still a bearish trend. Hands down, no doubt, for sure, still a bearish trend. But one thing I have been noticing is our bull list is growing. We have 76 new buy names today, new buy signals, versus 8 new sell signals. We've got BSXL, Cavawai, I don't know this one, Cyber, Dole, EIX, EWTX, LOMA, MLTX, all of these will buy signals today. And what this is measuring is the market breadth. And this matters because if you are looking to buy a stock, right, you don't want one stock to just be going up. You want the whole market to be going up, because a rising tide lifts all ships. So we want everybody screaming buy, buy, buy. And we're starting to see a turning point on there. We're starting to see more and more of these buying signals come through. So we do have a bullish cross right here. So while the trend is still down, more stocks are getting buy signals, which to me looks like we may have hit a near-term bottom. That's what I see. Michael says, for me, options are a foreign language. I get it, dude. I totally get it. But I also know that how important is it to you to learn this? It could be the difference in, your entire life. It's worth it to me. I don't know. Bill F says, I do like selling cash secured puts against stocks that I'm okay with buying at the current price. When a stock rises, I keep the premium. If the stock drops, I'm okay with having bought at the strike. I hear that. I understand where you're coming from. But let's use an extreme example of AMD. Was it worth? Now, granted, I'm not trying to judge you. I'm trying to give some context here for someone else who might be looking at this. Let's say that AMD was currently at 141, okay? And you were selling cash secured puts at the 130 strike. And then AMD comes down and you've now taken ownership of those shares. And now you're watching that was a great buy to collect the premium as the stock is going down and down and down and down and down and down. And it's like, what, did I really want to own it at 130? No, I disagree, because only price is going to pay, right? Same thing on Meta. Selling a cash secured put at, let's say, 600, because it has to go up from here. There's no way it can go lower than $600 a share. Not possible. It sounded like a great idea at the time. And of course, when it was trading up at 650, oh, I'd love to own it at 600. And now when it's down at 520, did you really want to own it at 600? Yeah, I don't know about that. So, Bill, certainly don't take that as a criticism, but think of it as something of, hey, you know what? If the stock's going down, that's the last thing I want to do is own it. For sure not. Theo says, I know nothing about options, and I took a gamble on call options and got lucky 2 out of 8 trades. Never again, unless Chris makes us nearly experts on options. I hope I can help with that. Nico said the market looks like consolidation. It might. Stock market with Bruce. Okay. Oh, Bruce Wayne. Yes, for sure. Bill says the popular options trade is credit spreads. This is what all the cool YouTubers are pushing people into losing large amounts of money. Yeah, for sure. In fact, let's price one out. Let's say that we were going to do a cool YouTuber move of saying, if Meta's at 520, then it can't go lower than 500, right? There's no way. So we'll sell a credit spread. We'll sell a 500, 490 credit spread. So no big deal, right? As long as it stays above 500, no big deal. I mean, it can't go lower than 500, can it? Can it? Right? But if we do this, we'll take in $3.27 in credit, meaning that on a $10 wide spread, so 10 minus 3.27, we'd have $6.73 of risk. So if we happen to lose the trade, which it's possible, anything's possible in the market. If we lose on the trade, I now need at least 2 trades divided by 3.27. I need, at least 2 trades just to get back to break even, which sucks, right? I've lost 1 trade. Now I need 2 just to make up for the 1 loser. Ugh, that sucks. It's not as bad as some people, but that still sucks. And certainly it would suck to say it can't go lower than 500 just to watch it take you out. Let's see. Theo says, Chris, do we buy blindly stocks with a buy signal, or do we take into account several other parameters? Dude, I would never, ever blindly buy with the buy signal. No way. Now, the Outlier 3.0 signals are literally 3 times as good as the Outlier 2.0 signals, but that doesn't mean that it's carte blanche to just buy whatever. No. You need to figure out first, is the market moving in your direction, right? I wouldn't do anything unless I had all 3 of these lined up. If the market was moving in my direction, plus the sector, plus the stock, then I'm way more likely to take on a buy signal. But that's up to you, my friend. You need to figure out, because this is a great question. You need to figure out your own trading plan, what you're looking for, and then write that down. Mikey Mike says, I love the big possibilities and options. I do too. That's why I trade them. Yeah, and then you're going to own AMD at 85. Gene says, what happened to me? That happened to me when Starbucks was at 120. Okay, let's go look at that. Gene, thank you so much for sharing your story. Right. So when Starbucks was at 120, he was like, I'm going to sell cash secure puts, right? Let's say I'm going to sell the $100 strike while Starbucks is up at 120. And I would love to own it at $100. That's what people always say, right? I would love to own it at $100. And so, I mean, I'll just collect the premium. And if it ever comes below $100, whatever, I'll just buy the mess out of that. And now it's down to 83. And it's like, well, I really don't want to own it anymore. I don't really want to own it anymore. So yeah, that is a real thing. And that really does happen. Randy says, the only time I sell an option is for protection in a spread. Otherwise, only long. Very interesting. Bill says, Trump doing something weird? That'll never happen. Brian, I'm paper trading options till I get comfortable. I think it's a great thing to do. In fact, there was one time where I think it was after I blew up my account in 2016 on the elections, and different story. We don't have to go into that. But then I spent 6 months saving and paper trading the entire time. And I paper traded that like my life depended on it. Like I made it so important that there was no possible way that I would treat it as if it were less than real money. So I've been there, dude. I've been there for sure. Oh yes, it can go lower. Michael Ross says, thanks for the education for sure. Maybe one day we'll spend a lot of time understanding this. That's all right. I like having the option, not the obligation. There you go. So to Randy's point, when you buy an option, you have the option to exercise those shares, not the obligation. You don't have to. However, if you sell the option, you are obligated to then deliver on those shares or those short shares if the other party decides to exercise that option. Vaclav says, as an EU retail investor, I will need to sell put options to get US ETFs like IBIT if I will want it. Oh, interesting. Okay. Bill says, no. AMD is not a stock I would buy at the current price. What are you trying to say, though? There are great option videos in the toolkit. Yes. So to Mikey Mike's point there, I went through and like tried to give you everything possible to get you set up here. If you go into the VIP Investors Toolkit, right, where's it at? Where's VIP Investors Toolkit? I've lost it. There it is. It's up here. We have so much information on how to trade, exactly how I trade, everything you'd want to know about options, right? We have tons and tons and tons of resources here for you. Definitely check that out. Thank you, Mikey Mike, for pointing that out. What's up, Jameis? Ben says options are worth the education curve. Chris is playing with them works. Maybe confusing at first, but it works. Yeah, for sure. Jose says, yeah, run away from credit spreads. Rocket Lab. Okay, Rocket Lab setting up for some options are still very valid for edging risk, for sure. So listen, I want you to know that I am here to help you. And the way that you can pay me back is by telling other people about this channel. That's all I ask about, right? Be sure to come back tomorrow where outliers like us will save time, make money, and start winning with less risk together as a team. Yeah, YouTube is going to pop up a couple recommended videos. I recommend you watch one of them, and I recommend you have a fantastic afternoon.